Welcome back to the Master Investor Show. Our next speakers today are Dan Whitestone of BlackRock Throgmorton Trust, George Barrow of Polar Capital Global Financials, and Jason Baggerly of Standard Life Property Income Trust. Dan Whitestone's talk was a favorite from last year, and it will be interesting to see how he views the prospects for UK small caps in the light of the COVID-19 pandemic. Meanwhile, the financial sector is facing considerable disruption from fintech, and this trend is likely to have been accelerated during the lockdowns. George Barrow of Polar Capital will explain how the portfolio is evolving in the face of these changes. Finally, real estate was supposedly a secure form of income for many investors, but there are now considerable question marks hanging over the sector. Perhaps Jason Baggerly can help put some of these concerns to rest when it comes to his talk about the SLI Property Income Trust. Please stand by for what promises to be three highly interesting presentations. Thank you.
I'm Dan Whitestone, lead manager of the BlackRock Throgmorton Trust. The purpose of this session really is to give you an overview of what this trust is about, what makes it different, unique, the attractions of the investment universe as we see it, to delve a little bit more into my philosophy and the investment process, and then to talk through some holdings and to sort of conclude with an outlook. So let's start with the overview of the fund. James, if you click forward, please. Next slide. Great. This is not like many other small mid-cap funds, whether long only or close-ended, but this is an investment trust. It can have a gross exposure up to 130%. So we can put more capital to work than many other traditional funds. We can also short shares as well as invest in companies with fantastic long-term growth prospects. So we have more levers at our disposal to generate alpha. And whilst I'm a big advocate of the attractions of this universe, there obviously are companies that don't meet our criteria and are fertile source of alpha from a shorting perspective. It also actually helps smooth out the volatility of returns of this universe through the cycle. It is predominantly a UK exposed investment trust, but I can actually hold 15% of my gross assets outside the UK. There are no private investments. So what I really mean by that is in companies in the US, in one case, Australia or Europe. So it's not just UK listed companies, but everything in the trust is listed. There's around 120 holdings. Through the cycle, it's generally around 80 to 90 long positions and up to 30 to 40 short positions. It's really prosecuting what I think is the attractive world of UK small and medium-sized companies. I'm supported by a team. There's 5 of us in my team. They have different funds of their own to manage, but we work collectively as a team. I'm a leader of that team, and most of our job is trying to turn over as many stones as possible, looking for exciting, emerging, differentiated and advantaged companies that we think have phenomenal long-term growth prospects. And so therefore we like to spend as much time as possible engaging with companies. And the 5 of us do over 700 company meetings a year. Next slide, please. Thank you. To try and illustrate what I'm saying about the growth of this fund, that most funds traditionally are just 100% long only, very straightforward. What do I mean by this growth of 130%? Well, we can have the same net exposure as a normal long only fund, even though we have another 15% exposed to long positions and 15% exposed to short positions. So the net of the fund is still 100%, only the gross is 130. So just to emphasize the point, I can allocate more capital, more risk. So obviously that works both ways, but in the long term, we think this works to the fund's advantages. And clearly I can change the balance between longs and shorts through time, changing the net of the fund. So if you take 2020 as an example, in late March, early April, The net of the fund actually went below 100%. It dropped to about 92%, but the net of the fund today is around 115%. So you can see the net changes through time, reflecting our conviction in individual shares and our conviction and excitement or view on the wider performance of equity markets, both domestically and further afield. Okay. I've really got to try and sell you on this, because ultimately everything I say after this is kind of irrelevant if you don't buy this slide. This to me is the case of why one should have exposure to the world of UK small and medium-sized companies. Very, very simply, £100 invested back at the end of 1955, that is what it's turned into over this period of time, compounded, 700 or nearly £750,000, which far exceeds the same investment in the same time period in the FTSE 100. The small mid-cap universe is an outperforming asset class, and I'm going to explain to you why. Next slide, please. The first thing that excites me, and one of the reasons why we like to have a short book, is that the dispersion of returns is very, very high. The rewards for success are large. When winners win, they can win big. They can go up 5, 15, 30 times. They can even become established FTSE 100 companies. Losers can go bust. 2 of my shorts in 2018 went to zero. We've had many shorts that have fallen 90, 95%. They've fallen 90% and fallen another 90%. That is there's a universe where the dispersion returns is high, and I think that can really magnify success, both in shares that we own, shares that we don't own, or shares that we are short. The second thing is that it still frustrates me to this day when I read about how everyone sees UK PLC as some like barometer or proxy for the UK economy. It really isn't. It's becoming increasingly less relevant. Many companies that I like and this fund's exposed to are companies that generate growth independent of the economic cycle. And that to me is incredibly powerful at times of like great market volatility or stress or huge economic uncertainty. There are many companies that can still deliver fantastic outcomes for shareholders by beating on revenues, by beating on profits, and by beating on cash flows, because they have something truly special, a product that people really, really want, where they can charge very high prices for it because they're solving custom solutions, and where demand far exceeds supply, or they're driving or exposed to huge secular trends in the market which triumph over macro political economic noise. And that is why these companies can become the leaders of the future. The third is that it's totally under-researched. This is a universe where every year fewer analysts are covering a larger part of this universe. And so when you combine inefficiency of a company's business model, any company bursting onto the scene doing something different to try and compete more effectively, generally it's revenues, profits, and cash flow can end up looking very different versus budget. But when you combine that with not many analysts covering these companies, and you have that wide range of financial outcomes, it can lead to very, very big differences in actual versus budget on revenues, profits, and cash flow. And that obviously can drive very, very big movements in share prices positively and negatively. And that is why it's an intensive job. I can't do this by myself. My team of 5 are critical to me, and we just want to meet as many companies as possible, constantly testing, retesting that investment thesis, trying to find the best ideas for you and to avoid mistakes or spot evolving situations in a negative way very, very quickly and act accordingly. The last point is it's a big universe. The FTSE 100 gets far too much attention. There's always such a narrow part of the FTSE 100. I'm not here pitching the FTSE 100 ETF. I'm pitching the universe of 1,600 companies not in the FTSE 100, of where there are some exceptionally interesting, compelling, differentiated, advantaged companies. They aren't just domestic proxies, okay? They aren't just retailers and house builders. There are some phenomenal market-leading, global-facing companies across a array of industries that we think are very, very compelling. The fact that I can also put 15% of the gross of my fund in shares not in the UK gives me an even bigger playing field in which to exploit and hopefully deliver better outcomes for shareholders over the long run. Okay, so by now, you should understand the overview of this trust, why it's different from other investment trusts. Hopefully, I have reinforced your own views of why it's a compelling place to invest. Now I want to tell you why you need to pick this fund, or why I think you should pick this fund over other funds that are exposed to this crazy, weird, wonderful, and wacky world. This is, to me, the most important slide in the presentation. Like, you have to be comfortable with what I'm about to tell you, okay? This is what I believe in. This is what the fund reflects. It's as simple as that. I really believe that there are incredible opportunities in this universe. I think these are often overlooked, and that is to be exploited because there are these great differentiated companies that can do huge things. And the things I want to focus on is, ultimately, I'm a growth investor. I want to own companies that can grow their revenues, profits, and cash flow far in excess of stock market forecasts, far in excess of the stock market, and they can do it repeatedly over prolonged periods of time. And that runway of growth is so compelling and so wide and so enduring, it leads to phenomenal compounding returns. I want to own companies that can go up many times. I'm not interested in trying to make 30%. I'm trying to own companies where their market caps can appreciate significantly through time. And you can only do that, I think, if you're something generally special about you, or you are leading industry change. And so, therefore, the whole fund is based on companies that fall into one or two of those very clear categories. Admittedly, there's often an overlap between the two. So the first I glibly call quality differentials. These ultimately are the characteristics I think lead to long-term compound success. Let me tell you, I don't start with valuation. I fundamentally believe this is the fastest way to miss out on the best opportunities investing in this world. It comes at the end. The criteria I spend all my time starting on is analyzing the things I think successful companies have in common. I start with management teams, the hardest thing to evaluate through a spreadsheet. It's why we engage with so many companies. I want to understand the vision of the company. I want to understand the depth and breadth of resource who are actually going to execute on that vision. It's one thing having a great vision, you need to actually go and execute it. And so it's about meeting and engaging with the people running product lines, divisions, or geographies. So understanding that vision, number one. Understand that management team, their ability to sort of under-promise and over-deliver, to focus on core, not be distracted by non-core ancillary areas. Two, to evaluate what is so special about the company, which really distills into the product strength. Ultimately, we want to own companies solving custom solutions. Therefore, price becomes much less relevant in the discussion. And generally, it speaks to barriers to entry. It speaks to pricing power. It speaks to the economic moat around that business, which makes it harder for low-cost, irrational competition to come in and undermine your pricing architecture. So we like companies that invest a lot in R&D, that have a large percentage of sales coming from new products developed in recent years. So it tells you that they're investing their money wisely and getting a great return. And that generally will translate into higher gross margins, higher return on capital employed. We also spend a lot of time analyzing the industry, because generally difficult industries can triumph over good management teams with a good strategy. Okay, so there's lots of industries we don't like because of low cost irrational competition, because of regulatory interference, because their capital intensity with marginal pricing and structural returns are being compromised. So we generally like to go for, or spend most of our time focused on industries which are dominated by big long-term secular trends, and where companies can grow in a capital light way, or where companies' market positions are particularly protected. And so generally that trilogy for us is great management team, great product in structurally growing industry. We then like to combine that with financial strength. We generally avoid companies that have lots of debt. We don't like debt. When you have a lot of debt, the main priority every month is generating enough cash flow to make your interest payments. And I generally think there's a high correlation between over-indebted companies and underinvestment. Well-capitalized, capital-light growth companies can invest at high rates of return. If they can't do that, then they pay dividends. They're not anchored to paying down interest payments or paying dividends to shareholders they can't afford. And this robbing Peter to pay Paul is sort of endemic on large swathes of the UK stock market, which obviously has come home to roost in recent months and years. So we like financial strength, and then we want our companies to convert a very high percentage of their earnings into cash flow. It tells you the revenues and profits are real, and that to me is probably a single metric: is what percentage of your earnings do you convert into cash? And from those cash flows, you obviously have many more levers about what you do next. Do you reinvest? We'd always advocate reinvesting at high rates of return. If you can't do that, or you've done more than you can do into diminishing law of returns, then start thinking about paying dividends. So that's what we care about. Great management team, great product, structurally growing industry, strong balance sheet, very important time of COVID crisis. It's no coincidence that the companies are coming out of this crisis in a much stronger position are those that went into it with a much stronger financial structure. They'll be able to take advantage of this crisis. They are much more in control of their own destiny, and obviously companies that have a very strong cash profile. We also focus a lot on industry change, where we look at how consumer behavior is changing, how technology can disrupt distribution, how it can disrupt manufacturing facilities, how it can lead to superior, lower unit cost economics and advantages that can have, and how that can filter through to pricing power, and how it can help you undermine legacy incumbent profit pools. So these generally is the focus for the fund. The characteristics lead to long-term compounding success, and owning the disruptors who are driving disruption across industries, principally through technological advancement, which really ultimately change distribution, changes consumer behavior, changes manufacturing models, and lowers unit cost economics. Let's move on, and we can see some slides. We'll soon come to some examples of this. Ultimately, this is basically the fund. The ideas can come from anywhere: colleagues, endless company research, the sell side, macroeconomic politics, and obviously working at BlackRock, we're inundated with resource that can help us look for ideas. I've gone through the criteria already that I think is most relevant to me, and then that computes into a portfolio, which is around 120 positions, as mentioned to you at the start. Longs can range in size anywhere between 0 and up to 5%, though most of my bigger longs generally around the 3% mark. Shorts can be up to 1%, but generally around 50 basis points. The net of the fund can vary between sort of 70 to 120. At the moment, it's around 115. And the gross also can vary between 130, but generally is somewhere between 120 and 130%. And ultimately, we've delivered the returns that we have without taking excess risk. And so actually the volatility is actually low and has been managed appropriately for the cycle. I can show you more information on that in due course. This is the compulsory performance using the rolling 12 months as of the last month, but the next slide is probably more relevant, so we just skip forward one slide. Great. So this is a November year end, this investment trust. What we have here is the performance since we took the trust over in 2008. I've run the trust for over 5 years. We've got the 5-year numbers, the 3-year numbers, the 12-month numbers, and we also have the 11 months to the end of October for this financial year. So the financial year ends next week, actually. So at the end of October, we're 5.5 ahead of the benchmark net of fees for this financial year. Over 3 years, the trust has compounded 11.5 ahead of the benchmark. Over 5 years, we've compounded at 9.3 ahead of the benchmark. So, and obviously it's a benchmark that's outperformed, but this trust has significantly outperformed an outperforming benchmark over 5 years, 3 years, 12 months I've been running it, and obviously since we took it over in 2008. Here is an overview of my top 10 holdings to the end of October. So the most relevant period that we can show you. And I think hopefully there's no better way of like bringing to life, I think, what I said without them picking on actual shares to exemplify this. Okay, so many of these companies you should be familiar with: Games Workshop, Watch to Switzerland, Pets at Home. Others less so, like Gamma Communications, YouGov, Integrafin. Let's pick on Games Workshop. Like, this is a great example of why like things like GDP are just becoming an increasingly relevant metric in analyzing or assessing the performance, positive and negative, in shares. In theory, we've just been through the worst economic contraction in our history, and Games Workshop as a retailer should be completely exposed to that, to falling consumer confidence, to rising unemployment, yet it's had one of its best years ever. And this isn't an anomaly. Games Workshop's been enduring a phenomenal growth spurt for a number of years, principally because they have changed the business model to bring in many more cohorts of new players. Therefore, they've significantly increased the addressable market by lowering the price point required for many users to play their games. As obviously, this is a company that manufactures little figures which can either be painted, and that's the end of the story, or they can be played in a variety of scientific fantasy board games, which I think is professionally attractive in the world full of social media and endless subscription TV service. There's still a very loyal fan base that can't buy enough of these little miniature war figures. They've also changed the distribution model significantly. They used to be 100% UK business. Now the UK is about a third of their business. They've got into the US, they've got into Asia, and they've embraced the indirect channel, so they sell through resellers. And so that's not only are they manufacturing more products and have lowered the price point to bring in more customers, but they've also globalized the business. And this is scarce IP, vertically owned content in a world where the value of content is appreciating significantly. So to me, this is way more than just a retailer. That is the mistake. And that has translated into significant beats and upward divisions to revenues and profits and cash flow year after year. But even this year, in the face of a global pandemic, Games Workshop has delivered a financial outcome higher than forecast at the start of this year before the virus was even known about. That to me is a phenomenal example of the attractions of this universe when you find the right company. YouGov, we've owned this company for many, many years. You know, it is a global leader in data analytics, data marketing in a world that's becoming increasingly digital, and they have a superior, differentiated, unique offering, which is driving bigger and more established, well-known customers to YouGov's arms for their capabilities. Gamma Communications is a leader in cloud audio, visual communication. Obviously, I'm doing this call on Zoom. There's been a structural acceleration in the replacement of legacy telephony with the new wave of cloud-enabled audiovisual equipment. And Gamma are a leader in the UK in the provider of that solution to an SME and increasing enterprise user base, and have also acquired in Europe, where penetration rates of cloud are in single digits. And so the runway of growth is very long. Yes, Gamma have benefited from COVID, which has accelerated this industry trend, but this is a structural trend that's been in situ for a number of years, and it's a structural trend that will continue for many, many years. And a great example of, like, people talked about Brexit. Do I really think Brexit, whatever the outcome of Brexit, is going to change the fortunes in the medium to long term of shares like Gamma Communications and YouGov and Games Workshop? And the answer is no. I can go on, but what these companies have is they have something generally special about them. Watch the Switzerland, demand for Rolex far exceeds supply. Deca Pharmaceuticals, what an advantage company that's built up many leading products in niche global veterinary pharmaceuticals. You know, I can go on, but I think by now hopefully you get the picture that I'm trying to portray. That's my top 10, but it'll be wrong to leave this without, you know, mentioning some international shares which don't feature in the top 10, but you know, I take full advantage of the capacity to go internationally. You know, shares in Xero, the Australian, well, it's actually dual listed in New Zealand and Australia, but a leading software as a service tax and audit company, which is there are basically three companies that control this market. It's Sage, Intuit, and Xero, and they've just delivered phenomenal growth in subscribers and in revenues from their compelling offering over a number of years. And again, the runway of growth is very, very large in accounting software, because there's still a lot of people using spreadsheets, and there's a lot of people that are using on-premise software that ultimately want to embrace the cloud for better functionality, lower cost, less complexity. So hopefully that gives you a good overview of the trust. If we just flick forward a slide, I always think it's important to tell you this, and some may like it, some may not, but ultimately I don't sit there obsessing about what's in the benchmark. I own the companies that I think have the strongest prospects for growth and that meet the criteria that I've spoken about, because I think that will lead to the best long-term financial returns. I don't see that in resources and in mining. It doesn't mean that it's not lost on me that there are periods where mining and resources can be in favor. This could be a moment, you know, right now. Obviously, gold mines have been very strong this year, but it's not where my skill set is, and it's not where I see the best compelling long-term return. So even though combined they are around 9% of the index, the fund owns zero in those sectors. And so obviously that does inject some risk into the fund. If they do very, very well, then the fund could underperform versus benchmark because it doesn't own a sector of the market that's going up. But ultimately, in the long term, I want to own the companies that I understand, I think I understand the best, that I think have the best long-term growth prospects, are capital-light, differentiated growth companies. And so generally, I'm more interested in exposing myself and therefore you to consumer services, consumer goods, specialist financials, technology, profitable healthcare, and light industrials. But I always want to be transparent about that. Okay, the outlook. Massive uncertainty, I get that. But that can be an opportunity. It's an opportunity, not a threat, because this period in this virus has shown there's many companies in that top 10 holdings. If you go through their updates this year, you'll see they've delivered phenomenal things for shareholders in this face of a global pandemic where there is no playbook. I don't just mean they've done well relatively, I mean they've done well in very absolute terms, because they have delivered huge upgrades to revenues, profits and cash flow since the start of the year, even before the virus turned up. And if there is no better reference point into illustrating the attractions of my universe and my philosophy and process than pointing to many companies that have delivered these great financial outcomes because they have a product that people really, really want. And that isn't going to go away tomorrow. It may not be in favor for 3 weeks. Everyone wants to buy shares that have underperformed, but in the long run, it leads to great success. There are two specific things happening right now, which I think really paint an attractive future, I think, for this philosophy and for the holdings going forward. Number one, there's acceleration in many secular trends. You know, I talked about cloud, video, audio communication. That's been going on for some time, but has accelerated in the last few months? Yes. Do I think the outlook for the medium-term growth of the industry has increased over the next 5 years? Absolutely. Video gaming, another example. Software as a service, digital payments. I can go on with, you know, e-commerce infrastructure. I can go on with many examples of where the long-term medium growth rates have increased. The second big trend, which I think is very compelling, and we can use 2008 as a great reference point, is that recessions and periods of crisis generally accelerate corporate Darwinism. The strong get stronger and use it as a huge advantage, and the weak disappear and capacity exits the market. And therefore, those who have strong balance sheets with strong offerings and have strong cash flow can take advantage by acquiring other customers, investing more in their products and winning more market share. And that can enable them to generate strong revenue and profit growth, even though the end market may take some years before it actually starts to recover. And you saw it with like Howden Joyner in the kitchen market in 2008. You sort of Ashtead as a provider of non-residential construction equipment in 2008. They actually can go to revenues and profits in absence of end market recovery. And then when the end market recovery comes, it turbocharges their growth rates even further in outer years. So it actually leads to a really attractive 5 to 10 year view from here, and we're seeing lots of that across lots of industries. And you can see, go back to my top 10 and ask yourself the question, who do I think actually will emerge from this crisis with an even stronger competitive product offering than they have now? Who do I think will see industries where capacity will exit, where competition will fold? And that is, I think, is very, very compelling. Meanwhile, I'll focus on the stuff that we like to focus on: distribution, disruption, changing consumer behavior, evolving manufacturing models, the relevance of data analytics and insights becoming embedded in every single corporate agenda, and those companies who can just deliver fantastic long-term compounding returns. If I keep doing that, then obviously the plan is to deliver something in the future, performance-wise, relatively, that looks like something that we've seen historically. And I think we just finish off with one last slide in the appendix, and this ultimately is a performance of this trust. You can see it's massively outperformed the index. It's massively outperformed the FTSE All Share, which obviously has a benefit of including mid caps, which has outperformed large caps. And I really think it speaks to one, asset class attraction, where there's a huge range of outcomes, it's under-researched, it's inefficient, it's a big, diverse, large global opportunity set. I think it speaks to the philosophy of this fund, the process that the team and I go through, and that has ultimately translated into, I think, a really long-term compelling performance record. I hope you agree, and hopefully what I've left you with are the reasons why, well, I've been analysing industries and companies for 17 years. This to me is about an exciting time as it possibly is. Like, the outlook for the profit pool and trajectory of some companies versus others, I think, is as best I've ever seen. The dispersion of returns will accelerate. I don't believe in mean reversion. There are some companies that are going through profound change, positive and negatively, and I think that will persist and endure in many years to come. And that, I think, it makes it a really, really compelling time to invest. Thank you very much for your time.